Hello, everybody. Right, so we're going to go from saving energy to burning some energy with blockchain and crypto now. So this is quite a technical subject area. So just in terms of making sure that we're all roughly on the same level of the room, we're going to spend a few minutes just running through some of the basic nomenclature, terminology, and making sure that we're all up to speed in terms of what we're talking about here. Just out of interest at first, does anyone currently work for or is using tokenized assets right now? Quick show of hands, please. Brilliant. Okay, that's more hands than I was expecting, but we still have an educational job ahead of us. So I'd like to hand it over now to Jack White, who's going to introduce himself. Yeah, take it away, Jack.
Cool. Thanks, Alex. So Jack White, I work for Citi, and specifically I sit within our security services business. So that covers custody, fund administration, really a lot of the infrastructure that supports wealth management and asset management. And I lead our strategy for wealth and asset management on data, digital, and innovation. So that covers blockchain, digital assets, as well as data, cloud, and other new technologies. So yeah, interested to be here today and see where the conversation goes.
Cool, great. So as I said at first, I think we just need to spend some time talking about what blockchains are, how DLT works, and the difference between crypto as a capital market and tokens, and how we can use blockchain / distributed ledger technology to, for a wider range of capital market uses. So yeah, Jack, I guess the first question is, what are we seeing in terms of the use of blockchain technology for tokenizing assets? And tell us what that means, how it works, and why it's beneficial.
Thanks, Alex. So I think we're increasingly seeing in the industry the realization that blockchain isn't just about crypto. It's not about meme coins and tokens and trading. It's really about infrastructure. So blockchain really represents the opportunity to deliver a more efficient capital market and regulated securities market, as well as these new asset classes that are emerging. It's the opportunity to deliver new use cases. It's the opportunity to democratize access to certain inaccessible asset classes that maybe haven't been sort of the domain of all investors in the past. I think certainly when we look at the industry activity at the moment, we're seeing the big players, the big financial market infrastructures, the big banks such as Citi and others, really starting to evolve and mature their use of blockchain and digital assets. I think just even this week we saw, in the last few weeks we saw DTC, obviously the major CSD in the US, Euroclear and Clearstream put out a joint paper on how they can cooperate and develop standards for the use of blockchain and digital assets for the markets. But in terms of what that actually means, we're seeing natively new digital securities that are issued on a blockchain. They don't have an analog twin, as it were. We're seeing the creation of digital twins or tokenized representations of traditional assets. And we think that's really important, actually, because if you think about, even if every new asset was issued digitally from today onwards, the vast majority of value is going to be locked up in traditional analog assets for the foreseeable future. So what these new natively digital or tokenized representations of securities allow us to do is gain administration efficiencies, get better data, better transparency, and potentially enable new use cases that we're starting to see in sort of the public blockchain space. And that's where a lot of the innovation is happening, but it's where the regulated entities are learning from and starting to implement in their own infrastructures.
Could you just explain for the audience what some of the pros and cons would be of having all this transaction data on public blockchains? Even if the wallets are pseudonymous and not identified, like there have got to be some considerations here that I think are important to have.
So just to level set, obviously public blockchains, we talk about, you think of Ethereum, obviously Bitcoin is the one everyone knows of and has talked about in the past. And really we draw comparisons to sort of permissioned or more centralized blockchains that have an entity that's responsible for managing them and gatekeeping them. When you look at public blockchains, there are a lot of new risk vectors involved in that. So I can just reel off a few now. So for example, there's the risk of knowing your counterparty, knowing your transaction, who are you transacting with, and what you know, are they sanctioned? Have they got AML, KYC concerns? And having that data public is certainly a concern certainly for regulated organizations. We are starting to see the emergence of things like security token standards, so a standard for creating a token that enables you to control who can hold it, who can transact in it, and how, and to be able to monitor that and enforce compliance rules, which is starting to bring that sort of public blockchain space a bit closer to the regulated environment. But certainly, we see, so at the moment, the majority of use cases for regulated institutions being in permissioned blockchains that are run by regulated entities. For example, like Euroclear's blockchain, which they announced the launch of last week, and shameless plug, Citi was involved in that announce as well. We supported the World Bank in issuing the first natively digital bond onto Euroclear's blockchain infrastructure.
That's quite a big deal, folks. I was hitherto unaware that could even happen, so I was surprised to learn about that only 10 minutes ago.
So our marketing folks who are in the room are going to be very upset that you didn't know about that. But no, we think, you know, not to plug Citi too much, because we know there are other organizations and other infrastructures that are working to bring that blockchain capability to the regulated markets. But we think that's a really important step. It's really bringing, I think when you look at the different asset classes out there that we as wealth and asset managers might transact in, bonds as well as private markets being probably a more acute use case, but bonds are one of the less efficient markets. So being able to start to bring more of those efficiencies, that transparency, that automation that blockchain can bring to the bond market, and do it at scale. And I think the really important thing and great thing about the Euroclear project is that it's fully scaled. It's interoperable with the traditional capital markets, but still bringing those benefits of digitization, of transparency, of better data, of things like atomic settlement, which sounds like a scary word, but basically it just means you've got no settlement risk, which when you're operating at scale is a major drag on the markets.
So just moving things to a slightly different perspective, what is the benefit for, let's say, a corporate choosing, let's say, a token issuance over doing a traditional equity capital market or debt capital market funding solution? I've been surprised that the first instances of this, of asset tokenization, there's quite a lot of government or pseudo-governmental agencies or institutions involved in trying to get this thing moving. Whereas normally with crypto assets, you'd probably, blockchain projects, you'd see this sort of more innovative, more aggressive, more sort of animal spirits orientated corporates trying to exploit what's going on. So, and get that cheaper, theoretically cheaper cost of funding. So two questions there. Why is there more government institution or pseudo-governmental institution interest in being the first movers in this space? And then secondly, if corporates do try to use this avenue, are they actually going to get overall cheaper cost of capital versus equity and debt solution or hybrid security solutions?
I mean, it's an interesting question, and one I haven't given a huge amount of thought to before, but just sort of thinking out loud, I suppose. These governmental or supranational organizations such as the World Bank, who we supported in that digital bond issuance, they bring with them a certain degree of scale to any solutions. And I think, especially when you look at corporate issuers, a big concern we see, and this is the same for asset managers actually, when they're talking about issuing maybe a digital fund, is what's the right solution? If I want, say I appreciate and understand and want to leverage those efficiencies and the benefits that digital issuance can bring, how do I know what the right place to do that issuance and the right way to do that issuance is? I think a lot of the concern we see from our clients, both investors and issuers, is about the digital islands that seem to crop up. You look at all the different public and permission blockchains that are springing up around the world. You've got For example, the Monetary Authority of Singapore is doing its own work, and that's actually on a public blockchain called Project Guardian. We're seeing numerous digital exchanges around the world who are springing up, and asset managers and other issuers are doing those digital issuances, but they have, at least up until recently, struggled to get scale. And I think a lot of the reason for that is around potentially a lack of interoperability between these digital islands. There's concern around fragmentation of liquidity, of distribution of assets. So what is the right place for me to issue an asset? What's the right place for me to invest in and hold an asset? And how do I build the infrastructure and maintain the infrastructure, given the pace of change in this technology is incredible? How do I, as an investor or as an issuer, build and manage that technology?
Okay, so security concerns are always there with blockchain and crypto. So yeah, can we move on to addressing how you manage the security aspects, trust, the robustness of smart contracts that you're deploying? Yeah, make us feel comfortable here. Tell me how much depth and how much time you spend in making sure that we're going to be able to get return of capital, not just return on capital.
So security has long been a concern around digital assets. I think primarily that's around public blockchain assets, so where assets are issued on a public blockchain such as Ethereum or others. And a big part of the reason for that concern is the whole, without getting too technical, the fact if you lose your keys, you potentially lose your assets. Or if someone compromises those keys, gets access to them, they can take your assets and there's no way to get them back. That's a big part of where the concern has been in the past. I think now we're starting to see the maturity of technology, governance, risk assurance oversight that is starting to mitigate some of those concerns. And we're also seeing the emergence of things like, I mentioned them earlier, security token standards that, for example, include the option to claw back those assets should they be lost to a bad actor. On the technology side, we've got some really mature solutions coming to market that use things like multi-party computation, or MPC. It's all these quantum-proof encryption technologies that can protect those private keys, even if you don't have that clawback ability. But again, going back to where we see the scale and starting to emerge, it's in, at least initially, in those spaces where there is some degree of central authority who can remediate any issues around lack of, loss of assets or loss of. Yeah, I mean, that's a good example. SocGen issued a stablecoin actually on a public blockchain, and in that they had one of these clawback facilities. They were able to cancel or are able to cancel those tokens if they get into the wrong hands. And so I think that's quite a, not an extreme example, but a good example of those sorts of capabilities that are becoming more mature now.
So, moving things on to perhaps a slightly overused word, but democratization of these hitherto sort of, these asset classes that were hidden, up behind these high access, high minimum investment ramparts, things like private equity, private debt, distressed debt. So what can the tokenization of, let's say, a private equity fund, how can that help wealth managers increase the available product suite to their client base if they're offering these tokenized assets through their platform? What are the implications for wealth managers in terms of being able to offer these previously inaccessible asset classes and investment strategies to a broader high net worth and retail client base?
It's a good question, a very topical one. I think we've heard quite a bit about private markets today, certainly in some of the sessions I've sat in on, which were including one from one of my colleagues in our wealth business. The first thing I would say is that blockchain and tokenization is not a silver bullet. It's not going to wave a magical wand and suddenly let everyone invest in private equity or other previously inaccessible asset classes. I think not to focus too much on it. I know that the subject of this is digital assets and tokenization, but digital is really important here as well, and the data that's associated with these assets and funds. So we're seeing a lot of the emergence of solutions that provide better data around these assets that have historically had a very fragmented administration and data ecosystem, a lack of standardization, a lack of automation, lots of uses of faxes, email, PDFs, even physical paper a lot of the time. So I think the data side of things and getting better data around these assets is really important. But then moving on from that, and you can only start to tokenize once you've got good data, by the way, the sort of the next logical step for that is that tokenization. And we're seeing a lot of uses for tokenization to reduce investment minimums. And the way that they rationalize a lower investment minimum is in a few ways. So there could be administration efficiencies. So if you're administering this fund natively digitally, rather than it being a digital twin of an existing fund, then you are seeing, and we're seeing examples of, lower administration costs, more automated things like compliance checks. A lot of I think if you've ever tried to transfer an LP interest, you'll know that that's a multi-month process in many cases. And a lot of that is because of the processes that have to be undergone. So GPs need to be comfortable with the new LP that's coming into the fund. They're maybe not getting the right identity data around them. There's lots of lawyers involved, no offense to lawyers, but I think tokenization and these blockchain-enabled ecosystems can deliver better data, better multi-party transaction capabilities where multiple parties need to be involved in approving a transaction, so they can bring those administrative efficiencies. I think blockchain and tokenization could also enable better liquidity of these assets from a secondary market perspective. Again, blockchain, tokenization isn't a magic wand that can suddenly make an illiquid asset liquid. But what it can do is provide a better settlement and transaction infrastructure to support the movement of these assets between owners. But again, we come back to this concern around the fragmentation of the digital islands. So you see organizations like KKR, Hamilton Lane, Apollo issuing digital versions of their funds, but they're issuing them in little pockets around the world and in different blockchains, which means that they struggle to achieve the network effect. And so what we're seeing is the potential to deliver a better interoperability between different blockchain networks, normalized access across all those networks for investors and issuers, and better technology that can move between those networks.
Okay, but what does that involve? Would that mean somebody would go to Citi, for example, and you would act a bit like an aggregating prime broker across all these different tokenization pools? I'm not sure if you can talk about that, about Citi specifically, but just give us an example of how that would look, or it might look, to somebody who wants to access tokenized assets, but again, doesn't want to have to set up dozens of accounts across different venues globally to access it.
I mean, it's a really good question and a very helpful one, actually, because I always draw the pattern back to the traditional markets. You look at how investors and issuers already invest in and issue assets in multiple networks around the world. They may not be blockchain networks, but they issue assets into central securities depositories. They have TAs in different places. And the traditional global banks, like Citi and our peers, not just Citi, but our peers as well, our role historically has been around normalizing access to those different networks, providing a unified operating model. So the reason people use Citi as a global custodian, for example, is because they don't want to set up branches in Taiwan, in Singapore, in the UK, in the US. They want a single, unified, normalized access point that can make their own operations more efficient and that allows them to focus on their value proposition. I think we certainly see a trend towards, and Citi sees value from our perspective in expanding that role from traditional networks like exchanges and CSDs into these emerging blockchain networks, digital networks, and providing that single interface and single access point.
Okay, thank you for that. So just in terms of the strategies that institutions are using to manage risks, associated with tokenized assets. And when we say risk here, we're thinking more operational risk rather than investment risk, because a tokenized asset should theoretically be delta one, sort of pari passu with the underlying security. So just in terms of how they're reviewing the operational risk associated with a tokenization platform, this is something very relevant to me right now, because this is the precise kind of issue that I'm dealing with in my current project, trying to weigh up the different pros and cons of the bankruptcy remoteness, the use of SPVs, the trustee director, the issuance of notes on these structures, and what it actually looks like in terms of the robustness of the tokenization platform structure. Could you just spend some time telling us what sort of questions you've had from participants and what their biggest concerns are when they're reviewing a platform for prospective use?
No, it's a very good question. There are, and you mentioned we won't touch too much on investment risk. I think these things do feed into that investment risk point, especially around the pari passu point. How do I know this is equal to the underlying asset? But before we get into that, I think there's obviously a lot of concerns around compliance risk. We touched on that earlier. How do I know who I'm transacting with? How do I know they're trustworthy as a counterparty? How do I know I'm not transacting with a sanctioned individual? I think that these regulated permission blockchains solve a lot of that for you in the same way they do for traditional markets. So Euroclear's blockchain infrastructure, for example, only available to regulated FIs. We know them, we're happy transacting with them, we know they've got good controls and compliance.
So just in that specific instance, is the ledger publicly visible?
On that one, no.
On that one, no.
No. For Euroclear, as far as I'm aware, is available only to the parties to the transaction. So there's that compliance risk, there's the security risk, the technology risk that we spoke about earlier. But I think when we to go back to your pari passu point, I think a lot of the concern we get is how do I know I have an enforceable legal claim on the underlying asset? I've got a token here. Yeah. I've got a token here that someone tells me represents a building, represents a bond, represents a traditional private equity fund. How do I know I have a good claim on that underlying asset? We see, and Citi are experimenting with, and hopefully we'll be making putting out some thought leadership on this in the near future. That there are good, robust legal constructs that enable that claim. So you look at the role Citi's depository bank, for example, plays in traditional markets. We enable portability of an asset from, say, DTC into Euroclear, and we do that through a really robust, I think, 100-year-old legal framework with a lot of case law behind it, called the depository receipt construct. Now, I'm not saying that that's, again, a magic wand, but there are trust frameworks, legal frameworks, compliance frameworks that work for the current world and can work in sort of the new digital world as well.
Okay, good to know. So just in terms of blockchains and tokenization still being relatively new and nascent, new kids on the block, what advice would you give to wealth, given that this is predominantly a wealth management audience here, what advice could you give to wealth managers who are looking to access tokenization, either in terms of just simply expanding the range of asset classes and securities available to their customer base if they want to be particularly digitally savvy and ahead of the curve, but also more generally if they want to build fund products, or maybe if they're seeing either higher yields, higher risk premium, lower cost of capital, all of the capital market variables that make things attractive for them. What advice would you give them in terms of technology implementation? Where do they start? What are the first steps?
I think if you start with the business case, because we always need to look at the business value.
Fair point.
And blockchains often assume digital assets are often accused of being a solution looking for a problem. And that's fair in some cases. I think we're seeing a lot of real business value that can be driven from the use of blockchain and digital assets. I think if you look at So, for example, Citi a few weeks ago, and I'm using Citi's examples because it's who I work for. But we recently announced something really relevant for wealth managers, which is our partnership with the BondBlocks Bond Exchange. It's a regulated blockchain-based exchange in Singapore, but it's available globally. And they enable access to fractional fixed income. So bonds that used to be $200,000 lots, you can now transact and hold in them in $1,000 lots. So Citi now provides that. So we think that's got some real business value to wealth managers and others, but certainly wealth managers, in potentially enabling direct, more cost-efficient fixed income exposure for wealth management clients. We look at the private asset space, the private fund space. We think there's a lot of business benefit in terms of being able to access those assets for potentially lower net worth investors rather than the ultra net worth or institutional at the moment, because of the efficiencies that having that structured settlement infrastructure and transaction infrastructure that tokenized that tokenization ecosystems can give you. I think just leading on from that, I would also see we see quite a lot with some asset managers that we speak to, this acceptance of the accepted wisdom in that, well, we can't offer direct bonds to our investors because it just doesn't happen, or we can't offer, we don't want liquidity for private equity funds because people don't ask for it. And in fact, the reason they don't ask for it is because at the moment they can't get it. I think we speak to some private banks and they might have the offers for sale of a PE interest on their books for 6 months plus, 12 months plus, if it ever gets fulfilled. So I would sort of challenge that status quo and actually say, in an ideal world, what would my wealth clients' portfolio look like? And forgetting about the infrastructural constraints of the legacy ecosystem or the traditional ecosystem, what should I be aiming for? And actually work back from there. That's certainly something that I would push them to, and also to lean on your service providers. Big global organizations like Citi, we're investing significantly in these capabilities, and we're doing that so that our clients can leverage them. We think we've got the global scale, we've got the footprint, we've got the expertise. We've got across the world, we've got labs working on blockchain as well as other new technologies. So we want our clients to be able to leverage those and leverage our infrastructure to access these new assets and new capabilities.
So just to sort of finish up on, I just wanted to share my recent experiences in terms of working on a tokenization platform selection project. My Asian VC client is looking for an on-chain yield solution. They basically want to have a digital money market fund, T-bill money market fund. And we're early on in this process right now, but what I've discovered is that so far is that there are relatively few platforms out there with meaningful liquidity on them. So the client has set a minimum bar of $100 million, which is is pretty low given that these are money market funds, right? But a minimum $100 million of tokenized T-bill liquidity to access. So far, we've only managed to find 3 groups globally that have a tokenized money market fund. One of them we can't access because it's for US investors only. So that leaves us with a choice of 2. And in my early digging into these structures, what it looks like the client would be investing in is a sort of note structure rather than a pool of securities that's directly been tokenized, because as we've just discovered from Jack here, bonds aren't issued on chain yet, apart from the first one, the inaugural World Bank one. So we've got this weird situation where you've got a real world security that is already effectively dematerialized, and then it's being redigitized and then put into another legal vehicle, and then it's being tokenized, but it's not a direct tokenization. These seem to be notes. The SPV is turned into a note obligation, which is the actual security that's tokenized. So I've also discovered that there are a lot of service providers involved in some of these tokenization platforms. And so these are the challenges that I'm facing now. It's like we've got a lot of transformation going on from where we are in terms of the client just holding a money market fund in a brokerage account versus all of this transformation that's going on and a seemingly large number of service providers in the mix. And this is before we even get to protocol audits, protocol security, wallet and key management. So yeah, I'd like to get back in touch with you, report back on progress over the next few weeks as we go through it. But it's fascinating. It's been really interesting to see how it all works behind the scenes. But yeah, it looks pretty difficult right now, just in terms of getting my head around it. So sympathies with the audience if any of you are running through a similar thing where you're trying to choose a tokenization provider and a platform to access it, because it's not been a picnic so far.
No, I can imagine. It's it's a complex ecosystem. It can be pretty intimidating even for large institutions. So to go back to my advice, I would lean on service providers where you can, and try and sort of leverage their infrastructure wherever possible. Yeah.
I will be.
Thanks, Alex.
Okay, ladies and gentlemen, thank you very much. I hope we all learned, I certainly learned something there that was very informative. And yeah, I'll pass it over to our MC.